We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. In part two of our two-part series about the future of wealth management, we'll continue talking with Steve Horan, a consultant to the Investments and Wealth Institute. So welcome back, Steve.
Thanks a lot, Bob. It's great to be here.
Great to have you. Now, in part one of our two-part series, we discussed a variety of topics. What is wealth management? Is wealth management a profession? Will wealth management become a profession? And how wealth management is changing. In this episode, let's review a little bit of what we discussed, and then we'll pick up where we left off. We'll talk about technology, wealth management, business models, and ESG.
Sounds great. Yeah, I think a lot of the backdrop behind all of what we're talking about relates to trends that are affecting both investors and investments. So with regard to investors in both categories, there's a shift from public to private, right? So for investors, there's a shift from institutional wealth management to private wealth management as investors assume increasingly greater responsibility and control for what it is they need to do, particularly on the retirement side, and the shift, but not exclusively. And the shift from defined benefit to defined contribution plans is certainly emblematic of that. But there's another public to private shift going on the investment side as well, and that's the shift from public markets to private markets. And Cerulli just issued a report. And it documents a continuation of what we've been seeing, and that is that increasingly high net worth investors are incorporating private assets into their portfolios, and overwhelmingly the motivation to do it is actually to reduce their exposure to public markets. It's almost a negative running away from something motivation as opposed to a running to. I think the positive running to motivation would be, trying to dampen volatility and reduce downside risk. And there's arguments about how much that's actually done in private markets. But I think, we're seeing different manifestations of this shift from public to private. And I think that intersects with these topics we're talking about with regard to technology, business models, and ESG.
Yeah. So when we last left off, we were talking about a variety of things about how wealth management is changing. You just outlined some of them. Technology is changing the world of wealth management as well. We've seen the arrival of robo-advisors, and technology is always advancing, so there's always something new around the corner. Most recently, I was looking at Kitces.com, where he catalogs all the technology that's whether it's customer relation management or CRMs or asset allocation software or whatnot. There's a never-ending plethora of technology being introduced. So maybe talk first about the current state of affairs.
Sure. I think actually, let me do past, present, and future.
Okay.
As I kind of think of what a historical analog might be for this, I think of the introduction of tax software in the 90s. And it really didn't put tax accountants out of business, even though that's exactly what everybody thought was going to happen. Accountants are no less prevalent, but they do different things. And a lot of the people that use tax software weren't going to hire tax accountants anyway. And the tax accountants now, rather than doing the mundane stuff, are doing kind of the higher order strategic tax planning that the software is less adept at. And I think there's something similar in current state. So I don't think robo-advisors have put any advisors out of business. But they are fundamentally changing what it is that we do and how we do it. And, a lot of advisors are using, platforms to raise their gain. It in some instances, gives them the ability to spend more time with clients and give more of the high touch treatment. It also, in a lot of cases, is the adoption of digital platforms as a signal to both clients and prospects of competency. It might not be true competency, but it conveys that to a marketplace. And so, I think to a large extent, that's where we're at, in that it's changing, but not displacing what it is that we're going to do. And in the future, I think you're going to see increasingly use of nudges for spending and rebalancing. Yes, you'll see, the dollar cost averaging continue and tax loss harvesting. And I think what it's going to do is turn more advisors into true wealth managers. And one of the things that Investments in Wealth Institute has discovered through some of its research is that there's been a declining preference among high net worth investors for in-person meetings. They are just as happy to meet virtually as they are in person. I don't think that means they don't want an advisor with whom to meet, but again, it's going to change what it is that we do. And so what does the future hold there? I think one is that technology is going to increasingly be used as a signal for quality, rightly or wrongly. And getting back to that backdrop I was talking about before, there are some investments and some products that are far less compatible with digital platforms than others. So the public markets are much more compatible with digital platforms, and the private markets are far less. So, we're seeing these trends not so much converge, but almost butt up against each other. And I think as long as there's an increasing embrace of private markets, there's increasing embrace of in-person advisor. And I think that bodes well, but it does mean advisors are going to have to up their game. They're going to have to develop new skills. And fortunately, organizations like IWI have programs to help them do that, including a new course on private markets for advisors. Yeah.
So just a follow-up question on the notion of robos. For many years, investment advisors have placed the value proposition on the investment advice and the investment performance that they offer. But you touched on this a second ago. The introduction of robos into an advisor's practice may allow them to move the value proposition away from investment management toward other services that they may offer, whether it's things around trust and estate planning or income tax planning or retirement planning, and that the value proposition then becomes much more valuable if indeed the investment management services become a commodity.
Yeah, I mean, I think that's true. And to take it one step further, for me, what that highlights is that increasingly wealth management is becoming a team sport. And so, being able to offer a wide enough scope of services across which few, if any, individuals can become truly competent is what investors want. They want one-stop shopping. And more than that, they want to be able to integrate. They want their tax planning to be reinforced with their investment planning and their estate planning and vice versa. And so what you need to develop as an advisor is to be thinking about an advising team and a multi-competency team. And, I think IWI sketches that out very, very well, thinking about different bodies of knowledge that support investments, wealth management, retirement, and financial planning. And they're not separate and apart. They're certainly overlapping bodies of knowledge, but they are distinct unto themselves. And so the investment advisor, the real successful ones now are less solo practitioners and more team leaders, right? They're directing an orchestra and they're conductors rather than lead violinists.
Yeah.
And I think there's a technology analog there as well.
Yeah, it seems like this profession is moving in the direction much like the medical world, where a solo general practitioner is a thing of the past, right? And that you're now living in a world where you have to go into a medical facility where there are various domains of expertise, and whether it's right heart or gastro or something else, it's become more complicated, and the ability to focus, as you said, on becoming an expert in each and every one of these domains is quite difficult. So having a team member who has that expertise is seems like the wave of the future.
Yeah, absolutely, and I think that touches on a couple of other points, which is that, you know, technology, getting back to that, it's an enabler, right? It can be a core competency, but it's not the value proposition per se that we're trying to deliver. It should enable the value proposition. And what is increasingly emerging in most businesses, whether it's an asset management shop or a wealth management shop, is that you've got sort of two distinct groups. You've got an investment management team and you've got a technology team, neither of which can really speak the other's language. And lying between them is what CFA Institute in some of its reports calls the innovator. The one that can both translate between these two groups, but also articulate a vision, define the questions that need asked and answering, and the problems that need solving. And that requires communication. It requires leadership skills and strategic thinking skills. And these are skills that are typically developed later in one's career as opposed to earlier. It's usually, you know, the technical skills about, you know, what's the difference between a stock and a bond, public markets, private markets, that we develop earlier on. And it's these synthesis skills that tend to come with, dare I say, maturity, at least maturity in one's career, if not one's person. And along with that, these teams that in order to be that innovator, right, what you want to be able to do is develop a team with T-shaped skills. The stem of the T being the deep knowledge within some area, not all areas of expertise, and the top horizontal of the T being the ability to integrate, know enough about these other areas to be able to integrate that knowledge together into a vision and articulate that in a strategic direction for a team. And this is not, it doesn't sound like investment advice, but this is what's required in order to deliver it in a contemporary way that investors are expecting.
Yeah. So is that a good segue into talking about business models?
Yeah, you know, it's interesting. You know, we've been talking about business models for decades, and you know, our commission brethren battle it out with our AUM brethren, and you know, I do think increasingly investors are being made aware, if they weren't already aware, that maybe they do want to look for someone who's got, if not in a legal sense, in a professional sense, their best interests at heart.
Yeah.
And, you know, that story still has yet to be written, but it's pretty clear to me that's increasingly part of the conversation. And then that naturally leads into business models. And, pricing things as assets under management is not a perfect way to do it, but it does strike me as a less conflicted way than to have a model built on transactional volume.
Yeah.
And really, I'd love to think that this is a future state, but I don't see a ton of evidence for it just yet. But that is that, ultimately what we ought to be building our business around is outcomes for investors. And an outcome isn't necessarily, oh, I got you the highest return. And it might not even, and it probably isn't even, oh, I got you the highest risk-adjusted return. It's really, hey, you know what? I got kind of this amount of cash and I got these goals, and I'd love for that left side of my balance sheet to be able to satisfy the obligations on my right. And if they don't, you screwed up, Mr. Advisor. And if they do, that was a success. And if we can find ways to build our revenue models around client success on an after-tax basis, I think we'll end up aligning much more closely with investors and find ourselves sitting on the same side of the table.
Yeah. So would you characterize that, Steve, as less investment-based planning and more goals-based planning? Is that
definitely? I'm a huge proponent of goals-based planning, and I tend to approach it a little bit differently than most. I tend to think about my goals-based planning as trying to quantify, not just, okay, what's it going to cost for me to send the kids to school? What's it going to cost for me to earn my my lifestyle in retirement? And I can sort of put that on a present value basis. But I want to think of not just the magnitude, but the character of those liabilities. What risks are they exposed to? And then I want to think about how I can manage those risks in the context of the assets I have on the left side of the balance sheet.
right?
And when I think about those assets, it's not just the stuff that shows up on my brokerage statement or bank statement. It's for most of us, the present value of our earnings stream is far and away the biggest asset we got, but we almost never consider it because it doesn't show up on one of those statements.
Yeah.
And it is the most unique across investors in terms of its character and what risks it's exposed to. And trying to think about the risks on the right-hand side of sending the kids to school and managing my retirement against the risks on the left-hand side about earning my economic capital, it's just not the way folks think about it. But that would be my way of approaching goals-based planning.
Yeah. So as you're talking, I'm thinking about the need for planners, advisors to become more familiar with the works of Modigliani and perhaps Malevsky and some of the life cycle work that you've published in the past. And that would greatly enhance their ability to think more holistically, perhaps around their clients and this notion of what the appropriate business model might be, given that you're not just worried about investments, you're worried about the goals and whether the assets will meet the liabilities that they have. And manage and mitigate the risk that they'll face.
Exactly. And it's a tall order. I said on the front end, I'm not super optimistic we're going to get there anytime soon because it's a tall order. But the guy I've seen that's gotten closest to it is Stephen Campisi, who developed he called it a performance evaluation model that was built around the attainment of client goals and the risk a goal might be subject to over time.
Yeah.
And I originally sort of dismissed that as because I have a certificate in investment performance measurement, which is the very traditional, how do I evaluate performance and attribute it to different things in a very investments sense, but not so much in a goals-based sense. And but if you really think about it, that's really what our clients are interested in.
Yeah. We touch on that a little bit in the RMA program, where we talk about the exposure to the risk that you might have, what's the probability of it happening, what's the negative consequences of it happening, and then try to match the risk management technique, whether you're going to pool the risk or absorb the risk or avoid the risk entirely. It gets at a little bit of what you're talking about, and I think it's an area ripe for more research and discussion, quite frankly.
No doubt. It's definitely harder work. It's a lot harder work. There's no question.
It is. So a couple of things. When we think about the business model of the future, we just did a podcast with a gentleman named Mark Berg from Timothy Financial, and he's one of the few people that I've ever spoken to who has developed a profitable hourly only financial planning practice. And it's interesting because he's been doing it for 20 years. And we talked a little bit about this notion of, will that ever become a thing where you move from commission to AUM to hourly or subscription model or retainer? And his thought that is that hourly may be right for some practices, but may not be right for all types of investment management firms. And it might be harder for some large brokerage firms, for instance, to institute an hourly business model versus, say, RIAs or duly registered advisors. Any thoughts?
Yeah, I'd agree with them. And I just think I get very intrigued when I see hourly models being implemented. And it strikes me that he's right. The more sort of investments centric your service platform is, the less likely an hourly model is going to make sense. The more, dare I say, holistic wealth management type solutions oriented platform that you provide, the more hourly can make sense. So yeah, I don't think that there's a single best model, and I'd completely agree with him on that basis.
Yeah. Let's see. You want to turn our attention to ESG and
Sure.
what's going on there? Sure.
Well, geez, is there something going on there?
Well,
but yeah,
it's changing by the minute.
It does, and there's still an enormous amount of capital that has been allocated, nominally or otherwise, to ESG investments. And podcast listeners can't see the air quotes I'm putting around that, but if you're very liberal in your definition of that, it could be approaching a third of the world's assets, $25 trillion, or 28% of ultra high net worth investments are in some way, shape, or form labeled ESG. And it's really interesting to see it play out in the US and contrast that with Europe and Asia. That, a lot of the pro ESG advocates would say, oh, Europe and Asia are so far ahead of the US. And of course, the US, the ESG detractors would say, well, they're just misguided. But what's I think everybody agrees on is that despite this tectonic shift in assets into ESG investments, we have no evidence that any of it has decreased carbon emissions, increased human rights, leveled the playing field for underrepresented groups, mitigated soil erosion, made water more pure, or whatever outcome we would hope to achieve. And that's kind of okay. That's an indictment, but I put an asterisk next to it, which is that I don't know that we could have expected it to have that effect just yet. This is more than a fad, for sure. It will evolve, though, and it's in its infancy. It's taken us hundreds of years, not hundreds, 100 years for us to develop robust models of security selection and portfolio management. And you know what? It's going to take us a little while to get this angle down too. And I do think it faces some challenges. And one of the most practical and significant ones is defining the actual investment objective an investor would hope to achieve. ESG is such a broad field, and it means so many things, different things to different people, that on the one hand, investment managers love to do ESG because they can say, hey, listen, I didn't deliver that risk-adjusted return you wanted, but look at what I did on the non-financial side. I made the world a better place. And they can kind of get away with that because the objective of making the world a better place is so ambiguous. Yeah. And so being able to hand wave is a wonderful luxury to have. But I think ultimately it's a challenge to ESG. And part of that's also because the corporate reporting, what's coming out of companies to support whatever these objectives might be, is voluminous, to be sure, but it's not useful. Like as a portfolio manager, I can't take these reams of data and scenario analyses and everything else and aggregate that up into some metric that I can tell my investors how my portfolio that I built for you is different and better than the portfolio I built, or the index, or something. So those are some of the really big challenges, and kind of coming full circle to how we evaluate our work or how investors would want us to. We don't really have a model to say, well, how does an investor evaluate how good of a job I did building an ESG portfolio? I delivered a certain amount of return. I delivered a certain amount of risk. And maybe I delivered a certain amount of, I'll call it ESG-ness across some metric. And maybe you've got the metric. But even if I got that, how are you going to evaluate me? How hard are you going to pull on any of those three levers to say, I put that together in a recipe in a way that suits your goals and objectives? Because some investors may not want to give up one dime of risk-adjusted return in order to achieve an investment outcome or an ESG outcome, right? They may say ESG is great, just don't sacrifice any financial return for it. Other investors may say, okay, you can sacrifice some, but don't sacrifice more than this. And others may be, I don't care. I just want to save the planet. Yeah. And do what you have to on the financial side. I can't build a portfolio, the same portfolio for those three investors. And we don't have a way to really state investment objectives in those terms, nor to evaluate the outcomes. And that's what a lot of my research recently has been on, some of which is being published by the Research Foundation at CFA Institute and in the Journal of Investment Management.
So we talked about tall orders on the business model side. This is a tall order too, it seems, in part because on the one hand, we have the SEC doing what it can to require corporate reporting. We have the Labor Department talking about adding ESG funds to 401k plans. We have we have all these other influences. We have the investment management firms trying to get advisors to talk more about ESG. We have their clients asking advisors to talk about ESG, and we have the advisor in the middle, perhaps not willing or unable to talk because they haven't been well educated yet. And then at the same time, we also have people like Larry Fink telling the world that this is the way to go, right? This is the wave of the future, ESG investing. And although we may not vote our proxy statements this way, we will influence what goes on in corporate America, at least publicly traded corporate America, by virtue of our ownership in their stock.
Yeah, it's a very difficult position to be in. And what it's done is it's created a whole nother set of competencies that an investment advisor needs to have. And whether you do ESG investing or not, you need to be conversant enough in it to articulate why and why not. At least for some clients. I mean, some clients categorically have no interest. In fact, maybe the majority, never bring it up with an advisor, and that's great. But increasingly, it's being brought up. And so there's a whole new vocabulary and lexicon that needs to be mastered. Not just for the advisor, but for the investor as well, right? We're using language that not everybody we're speaking to understands. And then not only that, we need to become conversant, more than conversant, at least understanding in a much broader array of disciplines, from ecology to sociology to biology and chemistry and, you name it. It gets very messy, very quick, and it does put advisors in a challenging position, to be sure.
Yeah.
Again, I don't think it's going away. All right. I think it's here, and not everyone's going to become an ESG investor. But there will be an investor class that will continually want to achieve non-financial objectives with their assets. And if you want to compete for those assets, you're going to have to learn the language.
Yeah. So what advice do you have for our advisors who'll be listening to this podcast about how to become better educated and be in a position to help those clients who want ESG?
Well, the first thing I tell them to do is to read my research, but
that's fair.
But the second thing I tell them to do is that CFA Institute has a good certificate program in ESG. There's other programs as well, and you don't necessarily need a certificate. I don't think that's the point. I don't think clients are looking for advisors with an ESG certificate, but it's a way to develop an understanding of both the language and the challenges associated with investing in this space. Commissioner Pierce at the SEC, I think, articulates an overarching challenge very well, and she says that, if I know that corporate managers are to maximize shareholder wealth, I know both who the stakeholder is and I know what the objective is. And yeah, there's measurement error and questions around that, but it's a pretty clear remit that I understand how that should guide manager behavior, and I can articulate pretty well when a manager doesn't act in that shareholder's interest. But the second you say that there's some agenda beyond shareholders and beyond wealth maximization, now I don't know whose interests I'm supposed to protect, because the world gets very big very quick. And I don't know how to evaluate what basis, what are the appropriate trade-offs. If you're going to trade off some wealth maximization for shareholders against some other good for some other stakeholder class, what's the good and who's the stakeholder class, and how much of that trade-off is okay? And that becomes a very difficult job for regulators and even for shareholders to evaluate. So that's I think one of the overarching challenges, and don't get me wrong, I've spent a lot of time talking about the challenges. Investors that want to achieve something other than risk-adjusted return with their assets are perfectly within their right
Yeah.
and to do so, and they're not misguided. If that's how they want to spend their money, who am I to judge? I would just want them to have the information that they would need to know whether or not their money was well spent.
Yeah. And it's interesting. I think for a period of time, there were many reports that came out from Morningstar and others that said for a period of time, ESG funds had outperformed other broad equity groups. And then that reversed when oil companies went, et cetera, right? So it's a bit of a moving target to say these funds are better or not than broad-based funds, depending on the period that you're looking at. And so that becomes problematic. And the other is, I think, this notion of companies are being evaluated by various firms on high scores on E and S, but maybe low on G, or high scores on G and low on E and S, and whatever it is. So now you're left with this mishmash of I own an oil company that has good governance, but maybe not great environmental records, or whatever the case may be, right? And
exactly. So and you're going to make that trade-off differently than me. And they're not. Neither of us is wrong. And then, of course, there's the law of unintended consequences that we all learned about, right? So, we can actually document that there's a lot of carbon intensive assets that have been divested by gas and oil companies.
Yep. And
so we can sort of pat ourselves on the back and say, didn't we do a good job? Except that those assets didn't disappear. Right, they exist, and not only do they exist, they're being operated by somebody.
Right,
and who they're being operated by are private investors who are not subject to the same ESG scrutiny as the owners that would have held them in public markets, and now they're being operated. Might be an overstatement to say with reckless abandon, but without the oversight you would want them to have. You've just pushed them out into the black market, so to speak.
Yeah.
And so you can't see them, but nor can you influence them. And so I think, you're getting the exact opposite result of what you would really want to achieve. That's just an example of, I think, a myriad of unintended consequences.
Yeah. We've covered a lot of ground, Steve. Anything that we missed, or anything that bears reemphasizing as we come to the end here?
The only thing I would emphasize is to make sure folks tune in again for your next podcast, because it's pure gold as far as I'm concerned.
You're kind to say that, and no animals were harmed in the making of this podcast. So, all right. Well, thanks again. We'll hope you'll come back on in the near future when another report comes out, or we can talk more about the future of some other topics.
Would love to, Bob. It's always a pleasure. Thank you for having me.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments in Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsinwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsinwealth.org.